Welcome to the Cherry Bekaert Tax Credits and Incentives Advisory podcast. Today we'll be discussing the new audit technique guideline for cost segregation. My name is Ron Wainwright. I'm a tax partner in the strategic tax practice of Cherry Bekaert, specifically in the tax credits incentives advisory practice. Joining me today is one of my colleagues, Sean O'Leary. Sean, introduce yourself.
Hi, thanks, Ron. My name is Sean O'Leary, and I'm a senior tax manager out of our Charlotte, North Carolina office in Cherry Bekaert's Tax Credits and Incentives Advisory Group. I have worked with Ron for over 8 years on cost seg, energy, and other tax incentive projects. And interestingly, I do have a degree in electrical engineering from a prior career that does come in quite useful in working on cost seg and other energy projects.
Very good, Sean. So let's get started. So for our audience, on June 1st of 2022, the Internal Revenue Service published the latest edition of the Cost Segregation Audit Technique Guide, often referred to as ATG. The Cost Segregation ATG assists IRS examiners during audits by providing an understanding of technical information, examination techniques, and what to look for when reviewing cost segregation reports. The IRS put out the original technique guide in 2004, and the document has undergone various revisions through the years, with the latest being in 2017, and again, most recently updated on June 1st of 2022. So Sean, as we said, the IRS recently reviews the revised audit technique guide for cost segregation studies. So can you give us a little bit of background in regards to ATG and how the IRS uses an audit technique guideline in examinations?
Sure, thanks, Ron. Just to provide a little bit more background, the ATG is a document the IRS produces to provide really a roadmap for them to conduct an audit on really any tax topic, as it gives the agent conducting the exam a summary of tax authority and history related to that specific topic and an outline of how to conduct an exam. It also provides taxpayers with a framework to understand the IRS position on various technical issues within that topic and an idea of what to expect during an audit in terms of the information requested and the topics to be addressed. One thing I would like to point out is that the ATG is not the same as tax law, i.e. statutes passed by Congress or regulations issued by the Treasury Department or federal court cases, that are adjudicated by the various courts. Those items have priority in the hierarchy of the tax law and take precedent over an IRS publication such as the ATG. The ATG is really just the IRS's interpretation or focus within an audit that provides both the government and taxpayers roadmap, Ron, as you mentioned, of what to expect during the audit. A taxpayer is not bound by any position implied or referenced in the ATG, but should be aware of it and understand that it certainly has significant impact on the audit. A little more background on the ATG as it relates to cost segregation. As you mentioned, the IRS just released an updated version back in June of 2022. The prior version relates back to 2017. And as we'll discuss in a few minutes, the changes in the new version focus heavily on the substantial law changes that have occurred in the past few years, including the Tax Cuts and Jobs Act, as well as the CARES Act that was passed back in 2021, which have brought about significant changes in how real property is depreciated, which of course has a real bearing on cost segregation studies and how they are conducted. So Ron, now that we've covered the basics of what the ATG is, can you take a deep dive into some of the new topics that were covered in the recently released guideline?
Sure, Sean. So as you pointed out, the ATG is designed to provide guidance for IRS employees and is not authoritative. Tax professionals have used this document to guide in regards to correct methods to conduct cost segregation studies properly. So what's new in the IRS Audit Technique Guide for Cost Segregation? The ATG has now been updated with respect to information in changes of accounting method, depreciation, bonus depreciation, Section 179 expensing, Section 179 Cap D deductions, which just underneath the Inflation Reduction Act of 22, signed by the president this week, expands the benefits of 179 Cap D, often referred to as the energy efficiency deduction. It speaks also to Section 263 Cap A, or the Uniform Capitalization Rules. It also speaks to qualified improvement property. As we know, there was an error that occurred in regards to QIP, as it's often referred to, as part of the Tax Cuts Jobs Act of 2017, where the definition and class life of QIP was actually changed from 15 years and now has been reinstated. So in the audit technique guideline around qualified improvement property, it's instructing IRS examining agents to the new law. There's also changes in tax law that have occurred, as we know, through the PATH Act, through the Tax Cuts Jobs Act, and then, of course, all of the various tax laws that came, which are often referred to as the CARES Act. There's also specifics around land and building depreciation basis allocations. What I would point out to our listeners is that there is a new Chapter 8, which is specific guidance in regards to the electrical distribution systems. So in a conclusion, comparing the latest version with the new version, there is a push to further educate regarding electrical distribution systems and how an electrical component should be classified as either a structural component or personal property. We expect that future audits may likely look at whether the amount of the electrical distribution system taken as personal property lines up with the correct electrical load analysis for the property. So listeners should look for solid engineering-based cost segregation providers that can correctly analyze not only the overall methodology from the standpoint of how a cost segregation study is completed, but more specifically, the electrical loads of a property and each individual electrical component. So in essence, there is a lot of new guidance within the audit technique guideline. So Sean, if a taxpayer gets audited for cost segregation, what are some of the areas that the IRS might focus on?
Sure, thanks, Ron. That's really a great question and definitely worth of some serious consideration. So if a taxpayer does get audited, the single biggest thing to consider is the amount or percent of the building that is reclassified into personal property and land improvements, and to make sure those amounts are reasonable. Excessively high reclassifications into 5 or 7 year personal property or 15-year land improvements without a detailed breakdown of those amounts based on actual costs, are sure to raise a red flag. The service and the cost seg industry have years of data in cost seg projects, and there are some rule of thumb reclassification amounts to be expected for different types of buildings. So the 5-year property in a newly constructed warehouse is much different than that of a medical office building. Taxpayers should be aware of these norms and be prepared to justify it if it is outside of them. The next biggest thing to consider is the type of cost seg study that was performed and the level and detail of record keeping the taxpayer will need to provide. The ATG lists 6 different methods of doing a cost seg study, but emphasizes that the quote detailed engineering approach is the most accurate and frankly is the one that we use for all of our projects at Cherry Bekaert. Other approaches can be used, but may be scrutinized a little more heavily upon examination. Many cost seg practitioners use a quote rule of thumb study and simply apply average results of prior studies to a new property without doing a site visit or closely examining the actual cost of the building. The IRS is really particularly disdainful of this approach and said it is quote typically sketchy and inadequate. So taxpayers should take a close look at the type of study being performed by their practitioner and be aware of the risks if audited. And in regard to the record keeping, it's always best that the study be based on actual costs incurred and be wary of simply using broad estimates. So keep those contractor AIA documents and any significant receipts or payments. The ATG does point out some other areas to watch out for, including evaluating the amount of the purchase price of a building that is allocated to land to ensure that the amount is reasonable. The IRS instructs that the land should be valued on its, quote, highest and best use, but practically and technically, taxpayers should always consider approaches that are justifiable and that can be documented. Many cost seg providers use standardized land values for every and all properties across the country. But from our experience at Cherry Bekaert, we recognize that land values are highly dependent on location. So the land values in Miami, Washington, D.C., or even Austin, Texas, are greatly inflated from those in smaller, less urban areas. And some other areas of concern in a cost seg study include whether demolition costs of an older structure should be capitalized into land, which is non-depreciable, or into the building for new construction projects, and whether the indirect costs spent during construction, such as repairs and maintenance, or indirect labor costs, should be capitalized under the Uniform Capitalization Rules under Code Section 263A. So Ron, moving on to another topic that I think many of our listeners would be interested to hear about. Can you talk about, from a procedural standpoint, what the IRS will expect from a taxpayer during an audit examination? You know, what kind of information will be requested? How long does an audit take, and what happens if there is adjustment?
Sure, Sean, thank you. So for our listeners, cost segregation studies have become steadily more popular and utilized by taxpayers with respect to the acceleration of depreciation attributable to reviewing the building or the asset from a structural side and determining the 1245 property or the personal property, which will put the asset into a lower class line, and then of course the 1250 property or the real property. So I think the key when we begin to think about examinations is there will be more and more examinations. That is one of the reasons that we believe the IRS has recently updated the audit technique guideline. So speaking to that, in the introduction of the audit technique guideline, the IRS refers to the complexity of cost segregation issues. The complexity arises out of the fact that a cost segregation study not only identifies assets, such as molding and flooring, that can be classified, but the study also evaluates parts of the building structure, such as electrical and plumbing, i.e. the new chapter from an electrical perspective, and reclassifies portions of those components. The types of reclassification often require complex determinations, as I already highlighted, of electrical load, water pressure. In fact, the audit technique guideline actually says the study must also identify that, for example, 15% of a building's electrical distribution system, called an EDS, directly supports 1245 property, such as specialized kitchen equipment. And based on that conclusion, the study will then treat the 15% of the electrical distribution system cost as 1245 property, along with identifying branch circuits, as they're referred to from an electrical perspective. So the allocation of building components to 1245 property away from 1250 property is often a contentious issue in examinations around cost segregations. So the issue is contentious because taxpayers have a strong incentive to classify as much property as possible at 1245 property because of the tax benefits of doing so in the class life and then applying Section 168K or the bonus depreciation rules. So this contention came to a head in the landmark court case, Hospital Corporation of America versus the IRS. And the landmark case forms some of the basis of why and how cost segregation studies by tax law are allowed today. So when taxpayers are contacted for an examination, first, we would hope that they have engaged a professional to complete the cost segregation. Hopefully that is Cherry Bekaert. But what is important in that deliverable or that cost segregation study is a very detailed engineering approach from the actual cost records. While the audit technique guideline says that this approach is generally the most methodical and accurate approach, it is not always possible to get detailed construction cost information from a building. And so taxpayers often want complete cost segregation studies on buildings that are years or even decades old because there's still a tax benefit to be derived. In those cases, in examinations, there is likely to be quite a bit of contention because the records are not real time. There is another engineering-based approach, which is often called the detailed engineering cost estimate approach. The engineering-based approach is used when detailed construction cost records are not available. And while this method may not be as reliable as using actual cost records, the ATG, or the Audit Technique Guideline, notes that with this method, reasonable, accurate cost allocations are possible. So I cover this from the standpoint that you can see that in an examination, there are a number of points that could be contentious with respect to the detailed engineering approach that could be used or the detailed engineering cost estimate approach. So let's talk about an IRS examination. And really what we can see is really 13 elements of what would be deemed to be a quality cost segregation study, which is aligned with the ATG, or the Audit Technique Guideline. First of all, the IRS is going to look for the firm or individual and what type of expertise and experience they had in completing a cost segregation study. So again, when we think about the ATG, the preparation of a quality cost segregation study requires expertise in both the construction process and the tax law. And the Audit Technique Guideline notes that a cost segregation report should include the credentials of the team who prepared the study. So again, step one, preparation by an individual with expertise and experience is almost the first step in examination. The second step in examination is really the IRS evaluating, which the ITG describes as, well, what was the methodology that was used? So again, the ATG describes various cost segregation methods, including the engineering-based approach, the statistical approach, and the less precise approach, such as the individual residual method. Whatever the method used for the cost segregation study, the ATG notes that a quality study always describes the methodology was used. So that's the second step in an examination. Also, the use of appropriate documentation. So when we think about appropriate documentation, the type of documentation available will depend on whether the property is a new construction or an acquired property. In either scenario, the Audit Technique Guide notes that a quality study uses the best available documentation and recommends that a site visit be conducted to provide further support for the allocation of the study. The ATG also begins to talk about the interview that was conducted with the appropriate parties. So the Audit Technique Guideline notes that a quality study will include interviews with the property owner, the property manager, as well as with contractors involved in the project. The fifth step in an examination that you will find is the use of what's referred to as common nomenclature. So the IATG actually recommends that common and clear understood terms be used in the study when we think about 1245 and 1250 property and the various aspects of a building or a multi-residential building. It also speaks to the use of a standard numbering system. So the ATG recommends that allocations in the study remain consistent with any construction documents provided. So it actually creates somewhat of a nexus, to use the technical tax term, between the documents, being the cut sheets and the drawings, to the actual cost and the allocations that are completed in the study. There's also a requirement in the ATG that suggests that a legal analysis be conducted to support the classifications made by the study on the specifics of the property in the study. So when you think about the examination, there's also an element of what's called determination of unit cost and engineering takeoffs. So the ATG states that a quality study should thoroughly explain how a property class is broken down. These breakdowns should be consistent with the blueprints, the photographs, and other construction documentation. Organization of assets into lists or groups is also talked about within an examination, as well as within the ATG. So the ATG notes specifically that a quality study should list the assets by recovery period in a way that generally ties back to the taxpayer's fixed asset ledger. One of the other areas that is often looked at in examination is what's referred to as the reconciliation of total cost allocated to total actual cost. So in this case, the audit technique guideline and the examination process actually warns that the same estimating techniques that should be used throughout the study, and that the quality cost segregation study should avoid duplication by reviewing property that has already been classified as 1245 property. So again, a reconciliation of total allocated costs to total actual cost based on the same techniques, engineering or estimate or statistical, that were used in the audit or the examination, as well as the cost segregation study. Another area that often comes up in examinations is what's referred to as the explanation of the treatment of indirect cost. So the method of allocating indirect cost, often referred to as soft costs, such as for building permitting and contractor overhead, should be very clearly explained in the cost segregation report, because this is an area in the audit technique guideline in regards to soft and indirect costs that will be dug into from an examination perspective. The identification and listing of 1245 property. So a quality study, as well as what is looked for in an examination, should list all of the 1245 property that the study identified, i.e. reclassed into the lower class lives. And it should also show any 1250 property that was reclassified by the study. The ATG, in a final conclusion, notes, or an examination process notes, that a change in depreciation method is considered a change in accounting method by the IRS, and a quality study will take this into account, and there will likely be, if it's not a new purchase property, will be a 3115 that will be required be completed as part of the study, recognizing you're really looking at an asset that either has a 39 or a 27.5-year life, and you're reclassifying that asset into 1245 property to obtain the shorter class life, and therefore the applicability of bonus depreciation. So let me also answer the last two questions. How long does a typical cost segregation examination take? Our experience is that the examination could take between 90 to 120 days because of the items that I mentioned in regards to how deep the IRS examining agent could go in the cost segregation study. However, I would say that we have also had success in examinations of less than 2 weeks, because as we deliver what we refer to as a cost seg plus deliverable, it addresses any and all of the audit technique guideline concerns and or questions during an examination, and our deliverable already has answered all of those questions. So that is really kind of the summary, Sean. Let's move on to the next question.
So I'm wondering next if you could talk a little bit about the larger concept of cost segregation and its impact on taxpayers. What are some of the aspects of a cost seg study that many taxpayers might be unaware of that would be useful for them to know?
So I think the first thing that is useful for them to know, and it's an excellent question, is that the statute of limitations for a taxpayer under 6511 of the statute is 3 years. So most taxpayers recognize the 3-year statute of limitations, and once that lapses, then really no changes can be made into a prior or previously filed return. However, there is not that standard when we think about cost segregation studies. We can often go back 5, 10, 15 years and ultimately catch up the depreciation on an older building or a multi-residential building without having to file amended returns. As I commented, one of the last considerations of the issues in the ATG is the actual filing of Form 3115, where you can actually catch up the depreciation that you did not take for a period of 10 or 15 years or 5 years by actually catching up that depreciation in a cost segregation study. And as I mentioned, this is achieved through a Form 3115 that actually is an automatic accounting method change filed within the current tax return and actually catches up the depreciation to the current period, and you're allowed that large tax deduction because you've now broken the 1250 and 1245 correctly. Many taxpayers know that accelerating depreciation to a current year also allows them to reduce that current year tax liability. But what is much lesser understood is actually the lifetime benefit of a cost segregation study and how the concept of compound interest has a significant impact on the lifetime savings. So when you think about that, if we're looking at a building defined by the statute as 39.5-year property, or a multi-residential building at 27.5 years, and we complete a cost segregation study and we determine a significant portion is 1245 property, and then the 1250 property stays at 39.5 or 27.5, we're actually taking that depreciation and bringing it forward 26.5 years or 38 years. And so that's where often is overlooked what we call the lifetime benefit, because what ultimately happens in the compounding of, quote, that depreciation deduction over time is you ultimately create a permanent lifetime tax savings attributable to the cost segregation study. So Sean, we've been very respectful of our audience. We hope we have covered a number of key areas in regards to the audit technique guideline with respect to the cost segregation. So let's bring it to some closure. So Sean, any final comments from you on the discussion today in regards to the audit technique guideline?
Sure, thanks, Ron. So today, we focused heavily on the IRS ATG that again was just recently revised in June of 2022. And the nuances and the technical aspects covered in it, as well as what to be aware of if a taxpayer does get audited. But I think we should really hammer a little bit more to our listeners about the powerful benefits of cost segregation, as you touched on. You and I talk to our clients all the time about how nearly any dollars invested in real estate, whether it's the construction of a new building, the purchase of an older building, or even the renovation or expansion of a building, will typically generate significant tax benefits in the form of accelerated depreciation, again, as you mentioned, which drives up depreciation expense in the earlier years of a project and then drives down the tax liability in those years. And that results in, cash savings to the taxpayer. And these savings can be invested in other projects to produce even greater results down the road as those investments grow. The bottom line, I think, for our listeners is that they should always be on the lookout for taking advantage of significant tax benefits related to their investments in real property and using cost segregation as a tool to drive those results.
Very good. I would highlight, though, often we get involved in what are referred to as 1031 exchanges or like-kind exchanges. So cost segregation studies actually can be utilized in a like-kind exchange. And I wanted to make sure that our listeners understood that from the standpoint of actually the interplay with a cost segregation study and a like-kind exchange. And we have a thought leadership article coming out on that, and we'll be ultimately doing another podcast. So stay tuned for that. In conclusion, we hope today has been very informative for you. I would kind of conclude as follows. When you think about cost segregation studies, there's a number of implications that are ultimately going to be taken into consideration in regard. So let me kind of talk to you a little bit about positive impacts and potentially some negative impacts on a long or a go-forward basis. So when you think about the positive impacts of a cost segregation study, think about present value of catch-up adjustments versus a gain in a later year. Focus on Section 1245 property, which normally is not being appreciated in the building, and therefore that actually drives a much larger benefit for you as we're allocating from 1250 to 1245. I mentioned like-kind exchanges. So remember, there can be catch-ups and can offset boot on gain as well in a like-kind exchange. And there's also replacement property eligible for cost segregation as well. Think about bonus depreciation. Obviously, the componentization of the building, the reclassification of 1250 to 1245 can increase bonus depreciation, and that catch-up adjustment or that Form 3115 can be very substantial. Component only can qualify if time requirements are not met, by the way, on larger property. And think about AMT. So there's also the ability to change the underlying taxpayers' alternative minimum tax position with respect to a cost segregation study. And then ultimately can provide rationale for allocating gross receipts when we think about the domestic production gross receipts or 199A. So there is significant benefits. So we hope that this podcast has been informative, and we want to thank our listeners for today. And we will look forward to our next podcast where we talk about like-kind exchanges in the interplay of cost segregation. Thank you and have a great day.
Check out Cherry Bekaert's website, cbh.com, for the latest guidance and resources on federal and state credits and other tax and business topics. This concludes today's podcast. Please like, share, and subscribe, and thank you for listening in. Until next time.